about implementing the tax-based expansion strategy through recruitment of new taxpayers, to be precise, about 2 million taxpayers. And I think this is a welcome move. It's a conversation that we've had over the years. But the key question and focus of where these 2 million taxpayers would be coming from, the target is on, real estate. We are targeting also, the KRA is targeting the turnover tax regime, registered companies, agricultural sector, professionals, high net worth individuals, and the digital economy, but also bringing into tax perspective and into tax net the informal sector. It is worthy to note, Chair, that KRA is expected to collect about 6.8 billion over the medium term, and the core revenues would be from the Exchequer, Railway Development Fund, the Road Maintenance Levy Fund, amongst others. When you look at this and the expected revenues, this will be an annual average of about 16.9% over the planned period, compared to 11.2% projected for nominal GDP. But what is critical is performance of tax collection over the years. It has really fallen short. And one of the reasons why it has fallen short is because of the unfavorable business environment. And Chairman, I want to underline unfavorable business environment. And this has largely been caused by, matters to do with overambitious targeting of various taxes. And as we look toward this season, what we want to propose as an institute is to support data-driven revenue projections to address the risk of ambiguous targeting. Lastly, we should be aware that as at the end of March 2024, KRA only managed to raise 1.5 trillion in tax revenue, which is 82% of the prorated 1.9 trillion and 61.5% of the financial year 2023-2024 estimate of 2.5 trillion. We can only appreciate that in the remaining quarter, possibly the KRA may not meet its target. So as we move forward, it is important to take note of those revenue forecasts. Thank you.
Thank you very much, FCPA Georgina. Honorable Chair and honorable members of Parliament, the Institute has looked at various policy considerations, and our concerns are as tabulated here. One main concern is the inconsistency in the medium-term revenue strategy vis-a-vis the national tax policy and generally the administration of tax. One of the issues is the delayed implementation of the national tax policy, which the Institute and other stakeholders, including the National Treasury and Parliament, was able to approve it, but we don't seem to see it in the current finance bill, because the expectation was that as we develop the national tax policy, then we would be able to be consistent and tax would be predictable, certainty would be commercially representative. Stability of the tax regime doesn't seem to be here, because we are seeing changes to even what we had proposed in the Finance Bill 2023. The other issue on policy considerations is the urgent need for physical consolidation. We applaud the Office of the President for various austerity measures that was put across, but it would be important for us to assess and see how much that austerity measures has been able to achieve. We have to live within our means, but this seems not to be happening because of various supplementary budgets that again don't seem to be talking to the austerity measures. The other important thing that we ought to look at is the unbundling of functions. We have so much duplicated functions at both national and county level, and it would be important that we look at this and clean up our house in terms of the county functions and the national functions, especially the administrative functions. Number 3 is the over-reliance on a small pool of taxpayers. You'll note that KRA records show that 6.13 billion people are the ones who filed tax returns in 2022. That is including even the corporate organizations. But we are living in a country of over 52 million. Of course, remove young ones and others who are not able to pay. But this would be important that we move this number up. And a real concern for relying so much on the salaried employees. We've noted that the pay slips have been raided every now and then. Of course, that is the easiest target. But then disposable income, which would bring in indirect tax, VAT and such related taxes, become a challenge. So you'll tax the same person, motor vehicle levy, you'll tax the same person, PYE, 1.5, sheaves, you'll tax the same person, the housing levy, and everything. They are the same people who are in the middle class, and they take care of quite a number of things. So this over-reliance on the same pool of taxpayers is a real discrimination following the tax maximum of equity and fairness. And the fourth and very last, one of the policy considerations, is the ceiling of revenue leakages and avenues of corruption, because in the process of collecting taxes, there's quite a lot of revenue leakages within the collectors of taxes and even within the users of the same. The expenditure side becomes another challenge also. And this leads to, of course, if you overtax people, then you bring in the question of compliance and tax evasion, which again has to be addressed, because paying tax should be a motivation, and then it brings in compliance. With that, I welcome the CEO to make a few comments on some of the proposals that are in the Finance Bill 2024, which the Institute supports and is happy to really push them through. Thank you.
Thank you once again, Chair. As we dive deep into our submissions today on the Finance Bill 2024, we want to start that on a positive note by commending the National Assembly and the National Treasury on the progressive proposals that are contained in the Finance Bill that will go a long way in facilitating Kenyans through these tough economic times. And the first one is the proposal to enhance the tax-free pension contribution from 20,000 to 30,000 per month. I think that will go a long way in not only enhancing the saving culture within our country, but also availing the much needed finances to finance some short-term revenues. We look at also the proposal to exempt pension from tax, enhanced meal benefit from 48,000 to 60,000 is a welcome move. Enhanced non-cash benefits threshold from 36,000 to 48,000 per annum. We are looking at the introduction of affordable housing deduction and also social health insurance fund deductions from employees. Will also help them take home a little bit more and also increase their disposable income. And also we are looking at the transfer of businesses as a going concern, being VAT exempt is a very welcome move to help businesses to be able to transact freely. Notwithstanding that, the Institute has gone ahead and prepared a detailed proposal that are contained in the Finance Bill 2024 for further consideration, and we have been able to pick up certain specific clauses that we would request that your esteemed House can look at and enhance or look at reviewing. Thank you.
Thank you, CEO. I give it to CPA Fred Kimotho to take us through now the next level on income tax and the clauses that we propose to amend and the proposals we propose to enhance. Thank you, Chair.
Thank you very much. Good morning again, Chair and members. I'll take you through the income tax proposals together with my colleague, James Kimani. So I'll be taking us through the proposals that we have outlined from page 5 of our document. First proposal is on clause number 4. There's a proposal by the bill, under the bill, to defer the foreign exchange losses, to reduce that particular period from the current 5 years to 3 years. This one is very closely tied to what our chair on this side did mention, that last year actually we had this proposal to introduce the 5 years. So it appears now within a period of 1 year, we actually then proposing to reduce the period to 3 years. We are requesting the committee through your chair, if this period of 5 years can be retained. It is good for business in terms of stability of our tax policies, predictability, and also to ensure that we take care of the investors who have taken a very long-term view in terms of when they did borrow funds to invest in this particular area. So we hope that the proposal to reduce that period to 3 years can be dropped. Proposal number 2, Chair, is on clause number 5, which is a welcome move. I think the Institute is happy that this has been introduced. It is expected that it solves the issue of pending bills. Also, although we think there could be others of probably solve the issue of pending bills, but having said that, what the bill specifically is providing for is that when you supply goods to the government, or rather to public offices, the income that you get from that particular supply is a move, obviously, because it will save most of the bill to work with government from a cash flow perspective. The only addition, Chair, that we are requesting that is considered is that we include services as well, because government does not only procure goods, it does also procure services. So we think it would be good to consider both goods and services under this particular. So, Chair, is on clause number 6. Clause number 6 is basically a clause that was actually introduced under the Finance Bill of 2023 in the very exact wordings. And what it seeks to do...
CP Kimotho, hold on. The Vice Chair wants to make a clarification on something. Give us a mic.
Thank you, Chair. I think yesterday we did discuss this matter. I do not know whether you are okay as it is, because if you receive a payment, whoever is paying you will be told, is it the 5%? Now, how will it be treated finally, when you are filing the returns? Will it be a new tax or like an advanced tax? Because it's not very clear in the... And what are your proposals?
Thank you, Vice Chair. There are two proposals that are related to supply of goods and services to the public entities. So the proposal I'm speaking to is the one that is very, very specific to income tax. So the proposal you are reading to is a proposal that makes reference to introduction withholding tax at the rate of 5% when you are paying a non-resident, and the rate of 3% when you are paying a resident person for supply of goods. And I can make comments on both. I think we have, we will come to the one on withholding tax. My colleague will give the Institute's view on the part of the withholding tax. So the one that is under clause number 5, the one that I'm speaking to, is the one that is specific to when you recognize the income. What basically the provision is seeking to do is to say, if you supply a public entity today, and you are paid 2 years after, the law is seeking to allow you to declare that income the 2 years after. That's the period when you actually paid. What is happening today, the government day, irrespective of when you'll be paid, even if you are paid 5 years from now, or you're paid 3 years from now, or 10 years from now, you will be required to account for that income and tax today. That's why.
Because it is saying, the bill proposes to amend the Income Tax Act by introducing a new section 4C that will allow payment received by a person. So it says any payment received by a person from a public entity shall attract, is it 3% to, is it 5 or 3 or whatever percentage? Now my question is, finally, assume you are paying 100,000 and you are expecting to be paid 200,000. Now they will withhold that amount. How will you treat it finally? Because it's not very in the bill. Will it be advance tax? Will you be allowed to from the tax finally that you are supposed to pay, or what?
You get the question?
Yes. I think from a withholding tax perspective, the 3% for resident persons is expected to be an advance tax. What is that? At the end of the year, when you are doing your return, you are expected to take a deduction of that particular advance tax. We could check the institute whether the wording is actually very well done in terms of ensuring that that is possible, but that is the expectation, Chair.
Yeah, but this was the challenge, and maybe this is something we'll have to our technical team will have to think, because if then it's withheld this year, okay, but recognized as income for that person next year, then we need to think through the accounting for that difference. It's easy when it's a small contract, yeah, but think about someone who does a supply of goods, say worth 1 billion shillings. So 3% of that is 300 million shillings, which will appear on their taxes for that year as being advance tax, but you're telling the person to recognize that income when it is paid, which could be the following year. And also, remember the proposal we passed in the last Finance Act that makes tax paid in advance. No, it's actually here. Whether because then that person could easily be deemed to have overpaid their taxes for that year, and then they're allowed to deduct that tax overpayment of tax, I think in 3 or 5 years. So I think we have to think around how that difference in the number of years will be accounted for. You want to have an answer?
Maybe one final thing on that, Chair. What are your thoughts if you talk about the public entities only? What about the private sector? And if we are withholding by the public entities, and then we have a lot of transactions happening in the private, don't you think we should treat private and public entities same way in terms of tax?
Try to quickly respond to that, but we'll try not to interrupt you again because it's a very long presentation. But maybe Honorable Vice Chair, even without ISPAC responding, the question is, if you have private entities withholding this tax, then they fold up, and then they say they use the money, then I think that's going to lead to even more losses. If it is public, governments are going concern, you'll always get them. But public, private, it's a different story altogether. Please respond that quickly, and then you go back to the presentation.
Yes, thank you. Thank you very much, Chair. And I agree with you that we definitely need to look at this provision, because the withholding tax is due on, when you pay me, you withhold, then that automatically becomes my credit in my tax return. So I should be able to utilize that. However, I do agree with you from an accounting perspective that there's going to be a lot of challenges, because currently Section 12 allows you to claim withholding tax for the year in which that income is recognized, which means technically, even though the credit is appearing on my return, because the law is telling me to defer for 2 years, I can only claim it next year or the year before. So I agree with you. And I also agree with you on the issue of the private sector versus public sector. I think this was designed for 2 reasons. One, to assist with the cash flow for suppliers, but also to enable government identify these suppliers who are not in the tax net. Thank you.
Thank you. I can proceed. Thank you very much. So the next proposal, Chair, and thanks for that. So it's our proposal number 3. It's on clause number 6. what clause number 6 of the bill seeks to do is to provide an exemption for amounts paid or granted to public officers to reimburse an expenditure purposes of performing what is referred to as the official duties, notwithstanding the ownership or control of the assets purchased. So, and I think we should underline the words notwithstanding the ownership or control of the assets purchased. So, Chair, I think as I mentioned earlier, this proposal was there under the Finance Bill of 2023 in the same exact wording. We did submit on it. We think that it may lead to serious tax leakage if it is adopted the way it is. And again, to what the Vice Chair has alluded to in terms of, giving preferential treatment maybe to the public officers. In the unlikely event that this proposal is actually then retained, it would be good to open it up to all the employees, including the private sector. But our preference as the Institute is that the proposal is actually deleted in totality.
Just negotiate with your employer not to pay you and allow you to buy a very nice car, and then they can use your salary for the year. Proceed.
So the same reasons why, Chair, it was deleted last year, we believe that maybe this year it will also be deleted. It's not a good law from where the Institute. The next issue, Chair, is on clause number 8, which is basically seeking to overhaul what we call the digital service tax, or repeal digital service tax, and replace it with what we are calling significant economic presence tax. This is a welcome move, we must say, because it's actually trying to align Kenya with what is happening globally. You may have had the discussions on Pillar 1 and Pillar 2. However, when we look at the proposal very, very critically, the characteristics or the attributes of this tax have actually not changed. There are only two things that have actually changed based on this particular bill. Number one is the formula, and in which you are arriving at the tax. And actually, that formula is also impacting on the effective tax rate, because you'll notice that the effective tax rate now under significant economic presence tax is actually 6% compared to the 1.5% that we currently have under the bill. And of course, number two thing that has changed is the name, from the name digital service tax to significant economic presence tax. So the request there is to see if we can achieve the objective that has been achieved by the rest of the countries. Number one, by probably reducing the rate a bit, because we are almost quadruple the rate of digital service tax. I'm giving is a different name. So the proposal is to review the deemed taxable profit from 20% to 5%, and we believe that when we get to 5%, the effective tax rate will be 1.5%. It is significant economic presence. So we then have to define what is this significant economic presence. We think that we should then introduce some sort of thresholds, and the threshold here, our proposal is to align it with the threshold that we have for VAT, which is currently shillings per annum. So those are the two proposals, Chair, and we think that these ones, if adopted, they will continue positioning our country very, very competitively as far as digital economy is concerned, which I think we are already doing very well. Allow me to skip issue number 5. It will be addressed by the Chairman. But then go to issue number 6, which is on clause number 23A. So clause 3 is a straightforward one. I've seen this across the bill. There are quite a number of deletions of some exemptions that we do have. So the finance bill proposes to remove the tax exemption of income other than income from investments of amateur sporting associations. So the thinking here is that we could still retain this provision, mainly because the sporting associations do not necessarily operate as profit-making entities, and as a result, we think that the exemption would also help in terms of tapping into the youth talent that may have been affected in a major way by the employment crisis that we have in the country. So we propose that provision is deleted from the bill. The other issue is on clause number 23. The bill proposes to remove the tax exemption of capital gains relating to transfer of title of movable properties. I'll not go to that through that in a lot of detail, but the request is that since trusts are generally SPVs or special purpose vehicles, you kindly consider to delete that particular proposal. The other one is on clause number 25. Again, it is also seeking to reduce some of the exemptions that we have under the Income Tax Act. And this one specifically, what it is seeking to do is to delete interest or income arising from the infrastructure, from boards that are used to lease for infrastructure and other social services. So those kind of boards, the interest is normally exempt as we speak. But the bill is seeking to remove that particular exemption, and over and above that, introduce a withholding tax on the interest that is paid in relation to this particular board at the rate of 5% for resident persons and the rate of 5% for non-resident persons. The Institute supports the government in terms of expanding the tax net, but we think that this proposal could be reviewed in two ways. Number one, for the 5% that is being introduced on this particular category of income, we categorize that particular 5% as withholding tax that is final. So what that means is that on the infrastructure board, you pay the 5% and you don't pay any further tax, which is more or less like a gradual process in terms of introducing this particular provision. And also, the 15% could be retained for non-residents, but we think that if the 5% is treated as final, it will then encourage quite a number of investors. It will also help the government in terms of getting funds for this particular category of bonds. I'll allow my colleague James Kimani to take us through number 9 to number 12.
Thank you. Yeah, so moving next. The next amendment, Chair, is Section 25B(1). And on this one, Chair, the bill proposes to actually repeat the preferential income tax rate of 15% for companies that construct 100 residential units. And Chair, the challenge we have with this is that a number of investors have already put in their money for construction of these houses on the understanding that the tax that they are to pay is 15%. And therefore, repealing this particular preferential tax rate then creates a problem. And therefore, Chair, we propose that we put a proposal that the 15% will continue to apply so long as the construction company had received, the applicable licenses from the county government before the commencement of this proviso. The purpose of this is really to ensure that we have that certainty in taxation, especially for the investors. The next proposal, Chair, is on clause 25B, 3C. And on this proposal, Chair, the bill proposes to actually delete the threshold of 24,000 for the withholding tax relating to professional services and management and training. When we look at it, Chair, the threshold of 24,000 really prevents the low income earners, because if you then withhold on only all the services and all the invoices that are issued in reference to professional and management services, then actually these low income earners will be in perpetual deferred position. And obviously it creates a lot of administrative burden given what has happened in the last, say, 2 years in terms of the taxes, the administration of these taxes, and how the companies then have to comply with this. So our proposal, Chair, is to delete this particular proposal in the bill so that all the invoices and the services that are provided in terms of professional services, management, and training that are below 24,000 then are not subjected to withholding tax. The next clause or the next proposal, Chair, is really what we discussed earlier on the introduction of withholding tax on goods. And what the bill is proposing is to introduce, withholding tax of 5% and 3% for non-resident and resident, respectively. And our view is that for people who make actually supply of goods to the government, their margin are actually very, very low. And therefore, having a withholding tax of 3% for resident companies and also 5% for resident, it is quite high. And therefore, as an institute, we want to propose that we reduce this from 3% to 1% and from 5% to 2%. This will ensure that those people are not affected from a cash flow perspective and can be able to operate, their business with a lot of ease. Our last proposal from an income tax perspective is the withholding tax proposal that have been introduced at a rate of 20% for non-resident people who are actually trading in digital marketplace. And that would essentially mean that people who are making the sales of goods, sales of services through the digital marketplace, now the owners of this digital marketplace will therefore withhold tax at 25%. And our view is that this rate is extremely high, Chair, and obviously it will make our products become very, 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 competitive. And for us to be able to achieve the balance between the revenue collection and also ensuring that we are able to support the businesses, we propose to reduce that rate from 20% to 10%. So with that, Chair, now we come to the end of the proposals for the income tax, and I'll pass it to my colleague, who will then take us through the other proposals for VAT. But before that, probably we have a comment from our Chair.
Yes, we take you back to page 8. The Chair has to take responsibility for some reason. The motor vehicle tax, Honorable Chair and Honorable Members, this is a really matter that you may really need to think through. And the bill requires that members of the public and ourselves should pay 2.5% of the value of the motor vehicle at the time of taking the insurance. And the money should be remitted 5 days from the date of collection to Kenya Revenue Authority. It goes further and says 50% penalty for the uncollected tax. Should be paid by the insurance company just in case they fail to meet the deadline or do not collect. Now, it's an interesting one because one is, our concern is that this is taxing capital. When you buy a vehicle and it's valued, you have to keep paying 2.5% every year on the very, very capital that you use to probably purchase the vehicle. The other concern of the institute is that you will notice that the motor vehicle industry, already when you purchase a vehicle, you pay quite a lot on the import duties, VAT on import services. It actually takes care of almost, the taxes are almost 50% of the value of the vehicle. So already the institute has a position that the vehicle is already taxed at the time of purchase, especially when we import them. Further, as you move around with your vehicle, you are paying quite a number of taxes: motor vehicle maintenance levy, development levy, and other regulatory railway levy, among many levies on the vehicle already. It is likely also to impact on the insurance penetration because you will notice that in the country, insurance is not really taken up so well. So by doing this, it means that you are saying if the insurance premium is 4% of the value of the vehicle, then you are moving it to almost 7%. It implies that then payment of this insurance would be, uptake of insurance would be an issue. But remember also, of course, the law of insurance requires that you pay premiums in advance. But from the Kenyan perspective, if there are cases where insurance companies are even allowing people, because of the hard economic times, to pay insurance in installments. So how do we handle that? The question also arises on motor vehicles which are public. In the public service vehicles, automatically they will transfer this to Mwananchi because the cost of paying this tax at the time of taking insurance will simply be transferred. Further, this tax is a little bit and more so discriminatory because when you say the cap is 5,000 to 100,000, that means a vehicle from 1 shilling to 4 million shillings. What of a vehicle that is just an example of 10 million? It means then that person will be paying 0.01% of the value. This kind of tax really hits the middle class who have vehicles ranging between 1 shilling to 4 million. It really hits them. And they are the same people.
People owning cars between? You should tell us where you're buying cars at 1 shilling.
There are those that are packed and the chicken is in it. So the discrimination bit is that we should be able to allow it, put a percentage and open it up for everybody to pay. Commercial vehicles already pay advance tax on what they do. So our question is, how do we even treat these ones? Are you looking at personal vehicles only, exempting other vehicles because already they are in the tax-paying net? Given that these commercial vehicles are also used to generate revenue for the industry or company or corporate, the same revenue generated, the corporate tax arises on it, and many others. The penalty of 50% is really, really high for the insurance industry, and it just scares off businesses in this area. If you must, and we ask if you must raise money on this area, reduce the amount at least to 0.05% for a start, and not 2.5%. Remove the discrimination clause. Let's negotiate this one. And the Institute one proposes that if you must raise the money in this particular area, why can't you just increase the VAT rate? Currently, the VAT is 16%. We have Tanzania, 18%, Uganda, 18%, Burundi, and even Rwanda is 18%. We are at 16%. How much money does the government intend to raise on this particular one, which we could say, move the VAT rate to 17%, get the money, leave the vehicles? Thank you. I want to go to the VAT, and that I'll give it to CPR Robert Minor to start us.
Okay, thank you very much. I'll take you through the proposals that ISPAC has come up with from a VAT perspective. The first one is there's a proposed amendment to the effect that there's a definition of the tenure supply for exported goods. And the bill proposes that this will be deemed to have taken place when the person is in possession of the requisite export documents. Our request here is that we make it clear the documents that are being should be requested by the Kenya Revenue Authority, and we have listed them there. We are talking of the leading airway bill or the road manifest, C17, as well as the confirmation of exit. And our request here is driven by the fact that if you leave it open, then
try speaking a little away from the microphone.
Okay. Thank you very much.
And then
So
slowly.
Okay, thank you. Sawa, thank you. So our request here is driven by the fact that if you leave this provision as proposed, then you leave it open to anyone sitting at the Revenue Authority asking any manner of documents for you to justify that you have exported your goods. So by making it clear that these are the 3 documents that you are required to have when you have exported, then it will reduce possibilities of disputes when you have exported. So it's more of clarifying that provision. Then the other proposal is that the bill proposes to repeal 2 provisions in the VAT Act. And currently, these provide for an avenue of someone who has paid VAT in form of withholding VAT, and this is in excess. So these provisions allow them to offset against other taxes, whether that's VAT or income tax. And now the bill proposes a repeal of this. Now, what this means is that someone who is largely dealing with goods where they have very minimal output VAT, and you could have a case where someone is largely dealing with exported supplies, and only a small proportion of their supplies is taxable. So when this VAT is withheld by the other party, then they will have a credit sitting in their books and in their VAT returns, but they will not have an avenue of claiming a refund from the Revenue Authority or setting the same against other taxes, which is obviously, this was actually one of the reasons reasons why this provision was introduced, to take care of those people who are not able to utilize VAT withheld at source. So our request here is that these provisions are retained to ensure that these persons are able to either seek a refund from the Revenue Authority or offset the same against other taxes that are due and payable by them. It's more of ensuring that we do not again increase the burden that they'll be facing in terms of money being stuck in carrying. Then the other proposal is the bill proposes to repeal an exemption that is currently being provided for those persons who construct tourism facilities, recreational parks, convention and conference facilities. Now, unfortunately, this comes just after we've gone through the heavy rains, and I think I've seen a lot of tourism facilities being affected by the heavy rains. They have been destroyed, and a lot of them will have to be reconstructed. And we all agree that tourism is a major sector in this country, and we need to ensure that we encourage the same. It's a key source of foreign exchange currency in Kenya. I mean, all the international tourists who come into this country, they bring in the much needed foreign exchange. And in addition to that, we have been on a drive to promote domestic tourism in this country. So I think this is our request, that more so to provide an avenue for those who might have been affected by the heavy rains, to reconstruct and rebuild their facilities, and after which then you can evaluate whether to maintain the same. Then, following closely to that, we have a proposal to again remove exemption on supplies or persons who are constructing specialized hospitals with a bed capacity with 50 beds, with the relevant approval of the Cabinet Secretary. Now, looking at the manifesto of the current government, I think healthcare is one of the major agenda items. And we have, you have implemented very many policies that are meant to foster healthcare in this country. And then now the bill proposes to remove the VAT exemption. Obviously, the cost of healthcare in this country is very high. If you are accessing private medical care in this country, it's extremely high. We have a huge increase in non-communicable diseases in this country, and all this is actually affecting mainly the common monarchy. The hustler are the ones who are largely affected by the high cost of healthcare and accessing the same. And I think it is in the best interest of the government to promote private players to make more investment in this sector at a much lower cost, which then would ultimately drive down the cost of healthcare in this country. So our request here is that you retain the exemption here to just provide an incentive to private players to invest in the sector. Then the other one is on, number 17. We are on number 17 now. Number 17 is we are looking at the bill proposes to introduce VAT on certain financial services. And this is through the deletion of certain services that are currently exempt from VAT. Now, this is one of those unfortunate proposals that we are seeing here, in the sense that as a country we are seeking to become an international financial center. And I think we have the Nairobi International Financial Center, which may not have done much in the recent past. And I think we have a challenge. We've seen the head of state challenging the NIFC to do more to promote this country as a potential financial center. We have competing financial centers. We have Mauritius, we have Kigali International Financial Center, and I think as a country we cannot afford to water down the benefits that we have enjoyed over the years by allowing the growth of this sector. Now, looking at some of the services that are being, where VAT is being proposed, we have issuing of credit and debit cards. In this economy, we are trying to promote use of cashless economy, meaning you are trying to reduce the amount of cash that people are using. By imposing VAT on this, you are again pushing people back to the same. We have money transfer. We all do RTGS. Most of us will be doing RTGS. And again, we are imposing VAT on that. Foreign exchange transactions. I guess by this we will then be promoting the black market, where people will be going, besides the formal financial system to avoid a case where they will be required to pay VAT, to just exchange their, their currency from US dollars to Kenya shillings or the vice versa. Check handling. You can imagine the number of checks businesses process on a daily basis when they are paying their suppliers, and then we are imposing VAT on every check that will be issued. So again, when you look at the nature of services that are being imposed, or the proposal, where the proposal to introduce VAT is targeting, unfortunately, we are going to water down the benefits we've enjoyed over the years. And that added to the fact that when you look at it from an excise duty perspective, there's a proposal to increase the rate from 15% to 20%. And I was looking at a case scenario where if a business is incurring a charge, they are getting, they're being charged 10 million for some of these, services. They will be required to pay excise duty of 2 million, which is 20% of 10 million. In addition to the 2 million, they will be required to pay VAT of 16%. Now, VAT is charged on, excise duty is part of the tax base of VAT, which means that they'll be required to pay VAT of 1.9 million, 1.92 million, and the total cost in terms of taxes, VAT and excise duty, will be 3.92 million. Now, the effective tax, actually from a VAT perspective, goes up to 19.2% because you are paying on top of excise duty. Now, paying 3.9 million for a transaction where the cost is 10 million is obviously on the higher side. And that is why we are asking you to just maintain status quo by deleting the proposal to introduce VAT on these services. And then that follows closely on the insurance sector, where the bill is proposing the introduction of VAT on insurance services other than insurance premium. Now, there has been a lot of talk in the past that insurance penetration is about 3% of our GDP in the country, which is well below what to be expected of, considering the country, the status of the country in this region. And I think when you now introduce VAT, unfortunately, this cost will be passed on to the consumer. So it is you and I who are going to incur this cost, because the insurance companies will top up. The VAT will be passed on to the final consumers, which will not be good in terms of driving insurance penetration, because the cost of insurance premiums will go up, and unfortunately the penetration levels are likely to decline even further. So our request here is that you retain the status quo until we have a reasonable threshold in terms of insurance penetration. Thank you. Then the last one here in terms of our submissions from a VAT perspective is ordinary bread. There's a proposal to introduce VAT as opposed to zero rating the same. And we are looking at this from different perspectives. One is the fact that in addition to just raising the cost of ordinary bread, there are very many people who are employed within the value chain of bread. If you look at the manufacturers, we have very many cottages or local industries within very many areas that are nowadays manufacturing bread. That has created employment even in the rural areas. We have suppliers, we have distributors, and very many other people who have gotten employed because of this common commodity within the country. So looking at the overall cost to the economy, including the raw materials that are being supplied by farmers, then we are asking you to just do away with this and retain status quo, because the cost of this will actually hit the common Mwananchi, who is the hustler. It will be higher to them because they spend a lot of money on food compared to the middle class and the people who are the upper class. Thank you. Thank you. We submit share. Thank you.
Thank you, CPA Robert. On excise duty, Chair of the committee, CPA Christine Kahema will take us through.
Thank you, Chair. From an excise tax perspective, I think the first proposal to delete a very critical aspect of the excise duty is one that we would like to submit on. So what the bill does is delete the provision that allows excise tax manufacturers to claim a credit of the excise tax that is paid on raw materials. I think this proposal will really impact on businesses, because what this means that a manufacturer who manufactures excisable goods is not able to get a credit of the excise tax. So what they would have to do is pass that cost as part of cost of goods sold. It will have an impact on the on COGS, and it will drive the price, therefore resulting to an increase in inflation. It is a principle of tax, even as enumerated under the OECD, that for consumption taxes, the input-output mechanism should operate. You will also look at it from a national tax policy perspective, and the MTRS, when you look at the policy guidelines for excise tax, it had actually stated that taxpayers would be in a position to claim a credit on the raw materials that they have used, which are excisable, in the manufacture of excisable final product. This is an area we have submitted before, and the purpose of our submission was to extend the claiming to also be extended to packaging materials. So even as we are seeking for the retention of the section, we are asking that the claiming be extended to packaging material, because those packaging materials, so I'll give an example, plastics are subject to excise tax, glass is subject to excise tax, cartons are subject to excise tax, which are critical components in a finished excisable good product. We are saying that the credit be extended both to raw materials and also to packaging materials. Secondly, and very closely to that, this was one that was not in the finance bill, but we think it's a critical one on the same issue about glass bottles. As you are aware, the Business Laws Amendment Act in 2020 introduced excise tax of 25% on imported glass. This was increased again to 35%. And what happened because of the Kio case, when the manufacturer of glass in Tanzania raised an issue because of making his glass more expensive, EAC countries were exempted from the excise tax on imported glass. What we are requesting is that that proviso be extended to glass imported as well from COMESA, because at the moment we are contravening the COMESA protocol. Kenya is a member of both COMESA and EAC. We noted that the bill has really tried to exclude the excisable goods from COMESA, from EAC region. We are requesting that that is extended to COMESA region as well. So that speaks to number 2021. Number 22 is respect to introduction of excise tax on local plastics. Maybe just to provide context, when excise tax was introduced on plastics, that is imported plastics, the reasons that we received was that we want to be in a position to really develop our local plastic manufacturers. Now, the excise tax has been extended to them as well. This will have an impact on the local manufacturers of plastic, because by imposing excise duty on locally produced practice, we will increase the cost of production and thus increase the cost of goods that require use of plastic packaging. We understand that quite a number of our goods require plastic packaging, and on that basis, if we impose excise tax, and I want to tie this to another comment that I will be making with respect to eco-levy. The interesting bit with plastic is that we're introducing excise tax, and we are actually also introducing eco-levy on it. And I'll give an example with this Keringet bottle. The eco-levy on the plastic resin is actually at 150 shillings per kg. There's also excise tax on the plastic itself. There's excise tax on the water inside this bottle. Will make this product extremely unaffordable. Interestingly to note is that the eco-levy on this plastic container is actually much more than the plastic container itself. So those are some of the concerns that we are having with the imposition of the different coupled taxes across the same product. Okay?
Come up again on the eco-levy. How eco-levy is more than the price of the plastic itself?
Yes. So maybe just to provide context, the resin that is used to make this plastic container yes, the raising, is attracting eco-levy at 150 shillings per kg. Okay, so that raising, that 150 is actually more than the cost that will be used to manufacture that plastic itself. So that's something that really needs to be thought through. And over and above that, this plastic container is being subjected to excise tax. It is locally manufactured as well.
What do you think would be maybe a reasonable then eco-levy of that raising?
Can I please comment on that, because we have put in some recommendations on that when we are discussing eco-levy. Thank you. Okay. The next one is on excise tax on vegetable oils. Maybe just to provide context, Chair, we are trying to live a healthy nation, and this is something that you have also mentioned. And we were a bit surprised to see the introduction of excise tax on vegetable oils, because we are making these vegetable oils extremely expensive. And what we are asking is that the 25% excise tax on vegetable oils be removed. Okay? Sorry, there's one that I missed. Apologies for that. Yes, 23. So 23 was in the introduction of payment of excise tax within 24 hours. And this I know I have submitted on previously, because 24 hours really strained businesses' cash flows, because for excise tax, it is payable as soon as goods leave the factory. So when the goods are leaving the factory, sorry? Okay. When goods are leaving the factory, they haven't been paid for. So what happened is that 24 hours was introduced last year. We are grateful that we've been given 5 days, but Chair, we are requesting if we can go back to the old regime of 20th of the subsequent month. Maybe to explain why. This is because you may get 5 days for the first initial dispatch of the goods, but the fourth day, the ones that were sold, the ones that will be leaving the second day, the fifth day will only be available in the first instance, because you're channeling the stock every other day. So 5 days can actually be every other day, because goods are leaving every other day. Today's first day is another's 5 day. So we are requesting, for cash flow purposes and to enable and reduce the cost of compliance for these businesses, we are requesting that be reconsidered. We go to the old system of 20th of the subsequent month, because we always say, for tax, please let us work together so that we also collect the tax at the least cost possible for the government and also for the taxpayer as well. Clause number 25. This is on excise tax on telephone and internet data services. And you will know that some of these rates actually were amended last year, mostly the one for financial services. We returned it from 20% to 15%, and now again we are taking it back to 20%. The current 15% excise duty supports the growth in the digital economy by keeping communication and internet costs relatively affordable. We feel that raising the excise tax to 20% will discourage use of online services and digital platforms. We are moving to a more global perspective where most of the work, the growth is in the service industry. I think we should be seen to be promoting this kind of system, and increasing the excise tax from 15 to 20% would be detrimental to the industry. That's clause number 25. Lastly, clause number 26. This is with respect to financial services, money transfer services. Chair, and I will borrow from my colleague Robert. You can imagine we are also introducing VAT on financial services. I remember when excise tax was being introduced on financial services, based on the conversations we had, it was on the fact that financial services are exempt. We need to collect some revenue. When you read the national tax policy and the MTRS, excise tax is supposed to focus on goods that have negative externalities. Yes, there's an aspect of revenue collection, but negative externalities are the critical aspect of excise duty. Financial services in all senses do not have any negative externalities. Yeah? And on that basis, an increase to 20% will really, really be punitive. If it's for a revenue purpose collection, let us maintain it at 15%. Let us not increase it to 20%. Those are our submissions on excise duty.
Thank you, thank you. Now we give it to our senior FCPA Kwaka to take us through miscellaneous fees and levies act.
Chair, just let me finish on the eco-levy, and
Okay.
then he can take it up from there. So on the eco-levy, Chair, we note that the bill introduces eco-levy. The goods have been provided for under the act, under the bill, and the rates are provided therein as well. And our proposal with respect to this is a deletion of eco-levy at this point in time, for the following reasons. That the eco-levy as currently proposed, it poses a significant threat in several sectors. Punitive levies on the goods, and secondly, there is lack of certainty in the form of a coherent framework for determining which goods actually have an impact on the environment. We're also not so sure how those rates that were included there were reached at. This is our proposal, Chair, for eco-levy. As provided by the statutes, and secondly, there is lack of certainty in the form of a coherent framework for determining which goods actually have an impact on the environment. We're also not so included there were reached at. This is our proposal, Chair, for eco-levy. As provided by the Statutory Instruments Act and also under NEMA, an impact assessment needs to be carried out when a law is being introduced charging a levy. We would want to support this impact assessment to determine really what is the impact of these goods that have been listed in this list to the environment, so that we can be able to determine what is the appropriate rate of levy that should be applied on the goods. The is, and I gave you examples with the plastics. The plastic one is really, really high. And therefore, without a proper impact assessment, it may be very difficult to first determine which goods should appear on that list and what rate should appear on that list. In addition to that, we currently have the Sustainable Management Waste Act. The Act provides for a polluter pay principle. So you're being told if you pollute the environment, pay this. Now, over and above that payment, there is an additional eco-levy. So you're having a product being hit from all sides: excise, VAT, polluter pay, eco-levy. On that note, we are asking, Chair, that a proper evaluation be done. We saw this being done in Canada before the introduction of the federal carbon tax. It was also introduced in the UK before the introduction of the plastic tax. To provide context on the UK, the provision states that you will only pay the tax if you cannot recycle that plastic. So what does that do? It really encourages taxpayers with modalities to manufacture recyclable plastics, because that's what we want from an environmental perspective. So our proposal is we hold the implementation of eco-levy at this point in time. We engage on an impact assessment that will guide us as to the product and to the appropriate rate to charge for this. Thank you, Chair.
Thank you very much. CPA Kahama, let's have FCPA Kwaka.
Thank you, Chair. At clause 28. And clause 28, we have a very straightforward proposal, Chair, that we need to encourage people to use ATMs. The current finance bill, the way it has dealt with that particular section, is going to discourage the use of ATMs. And as an institute, we feel very strongly that ATMs use should be encouraged, and we therefore put the deletion of the word has not been declared. to be replaced with the words has issued a tax invoice. That will help the exchequer, it will help the country, so that we don't lose out just because of wordings. 29, Chair, is regarding the the TPA Act, withholding tax, a requirement that withholding tax be remitted within 5 days.
FCP,
yes,
could
sir.
you please come up again on section 17.2?
Yeah.
And how that proposal will discourage use of items?
Right.
Try to explain a little more.
Okay. The issue of concern under that, let me claim of input tax. The registered supplier.
And you're saying it is VAT section 17.2B.
17.2B. I hope we didn't have a typo there, Chair.
But what is a section?
Will just allow us to double check, Chair.
Chair, if I may.
Yeah.
So it is, okay, fine. So on the bill is clause 31, B. B what?
Chair, just to clarify, if I may. Yes, this proposal is not in the finance bill, but is in the finance act, is in the VAT Act. And what we are saying is that provision of the VAT Act ought to be amended to reflect that we have now transitioned to e-teams, and therefore I do not need to be holding an invoice, because Christine here will have already issued me a Teams invoice which carry already has.
That's fine. So it's a proposal.
Correct.
Okay. No,
Our apology.
FCP.
Thank you. Thank you,
I think
Chair.
we should just, for the sake of the others, if it's a new proposal, just tell us the new one so that you don't struggle to find it on the bill. Proceed.
Agreed, Chair. The next item is our number 29 regarding withholding tax and a requirement to remit withholding tax within 5 days. And our proposal is that should be changed to be remitted by the 20th of the following month, as we have in other cases. And Chair, it is because this provision of 5 days, we have talked about it before, is very easy to avoid and very easy to evade by just simply bulking payments and paying them on the day you like. So if it is 5 days later, you can just bulk them and wait until you feel like paying it. But if legislation is specific, by the 20th of the following month, it will be much more efficient from a revenue point of view, Chair, and it will be good for our country, and of course also for the payer in terms of managing cash flow. Item number 30 on our list concerns the TPA Act again. The current proposal in the finance bill is that within 90 days, if a document or some information has not been provided, the commissioner will have the right to completely throw away the entire objection. And that cannot be correct, Chair, because in an objection decision, I might have 5 or even 10 items. And if I've provided information for 9 items and only 1 is missing, why would anybody throw out the entire thing just because of 1? And we propose, Chair, that we reword that to say to the extent. And then for the rest of the provision, Chair, we propose that we retain what is currently in the Act because it is much safer and of course it is also easier to deal with. The wording in the finance bill has used words like deemed. And Chair, the word deemed can mean many things. Deemed can mean an assumption, maybe, perhaps. It can mean also anything else. And of course it is perhaps not too difficult to challenge in court. Why don't we just lock the law in a way that is easy for us to manage as a nation? Now, when we talk about the retaining the current provision of 60 days, Chair, we are saying that the 60 days will in many ways open the way such that if a taxpayer has an issue, he can always appeal. He can always appeal to the next level. Then, Chair, I go to...
Sorry to interrupt, but
yes, sir.
The understanding of this was, so if you lodge an objection,
yeah.
So the onus is on you to provide documentation to why you are lodging that. Take your sweet time, take the 30 days, 60 days, and then you do not come back to the authority with the information. So what is the authority supposed to do at that particular time? So how then would you think that we should address this better? So say, if within 60 days you have been given a chance to bring documentation, you haven't, then that means you don't have a case. What would be your thinking around that?
Very right, Chair. But I might have given 5 out of 10. So would anybody be right to say that even the 5 which were good is all thrown out? And that's the point we are trying to drive here. And then the use of words like deeming. Deeming has got a lot of weaknesses in terms of meaning.
Hold on, Vice Chair has an addition to that.
You know, Senior, you are talking on behalf of very good taxpayers. But remember also we have very bad taxpayers. And that is what the law is made to cure. Because I know I have a liability. I lodge whatever it is, and then I use the documents to delay the process. Imagine you have been given 30 days, 60 days. You are not lodging the document. 90 days. I think let us have a middle ground where we must also help the commissioner to tame the bad taxpayers. I know, Senior, as I said, you are talking on behalf of very good taxpayers, and there are very bad elements out there.
Very true. In fact, Honorable Member, we are actually saying the same thing. Absolutely the same thing. It's for the good of the country. But I will also ask my colleague, CPA Kahema, to add.
Yeah, Chair, maybe just to provide clarity on this section, the section proposes to delete a very critical section of the Tax Procedures Act. So currently what would happen is that you object, you put in your objection, and the commissioner is supposed to give you feedback on the validity of the objection. He gives you a specific timeline to provide that document. If you do not provide the document, he will issue you with an objection decision in 60 days. That's the process. So there's a system that is already in place to ensure that if the commissioner feels the documents are not well provided, he has 60 days to provide you with an objection decision. Now, it is with an objection decision that can appeal to the tribunal. So what the proposal has done, it has deleted that clause. What it means is that if you do not provide the requisite information, your objection is invalidated. If your objection is invalidated, you as a taxpayer cannot appeal, because you can only appeal to the tribunal if you have an objection decision. So what we are requesting to be deleted or amended to the extent that even if he invalidates, he gives you an objection decision that will help you to appeal to the tribunal and to the High Court, because without a valid objection decision, my right to appeal has come to an end, which I don't think was the intention, hopefully.
Okay. Yeah. That brings clarity.
Yes.
Because then it's giving a window for KRA
Yes.
to give you like a blank assessment
Yes.
without giving them the obligation to communicate that to you,
Yes.
so that you can use that
we need to be fairly serious on that, because if you, from 2 million to 1,000, the proposal is not even, it's not acceptable. I think we need to have a reasonable proposal that can help to cap the problem, and which can also discourage, which can also help to safeguard the businesses.
Hold on, there's also a quick interjection from Honorable Makilap.
Senior, I think the proposal you can propose using a percentum, because a percentum is genuine, because it does not, it depends on what you have defaulted. Because when you put a flat rate like 1,000, and maybe someone else has defaulted little money, still punitive to that person and discriminatory. But if you use a percentum, it graduates everyone how much you are being to pay by carry, so that it makes it reasonable. So what's your thinking?
So maybe 10%?
Well received, Chair.
So maybe 10%, 5%? What do you think?
Can we give you a proposal after consulting?
Okay.
But this one is about integration of to e-teams, so it's not about any figure in particular. So it has to be a figure. Yeah.
Your business has a turnover, so it should be a percentage of your turnover. So that if you're a big business, you pay more. If you're a small business, that you pay less. Proceed, FCPA.
Right. A quick consultation is suggesting that we do 1%, and we totally agree, so that it is ad valorem as you go along. But 2 million every month.
That quick consultation was communication from the chair. If only government could consult that fast and make decisions.
With tremendous respect, Chair. Right. And my final point, Chair, is, almost final point, is on section 42:14. And this is regarding agency notices, which the Commissioner can issue. Number 34.
So it is clause 54, page 5?
Chair, if I may.
595.
That is clause 53C of the finance bill.
53C.
Yes.
The deletion of subsection 14.
Correct.
And deletion of paragraph E.
Right. So, Chair, that deletion may look so innocent, but the import of the deletion is that I can have a decision today in the morning, and in the evening or in the afternoon, a bank account with an agency notice. And it's a very dangerous thing, Chair, that we appeal that we retain the current provision without the suggestion to delete it. The appeal period for any taxpayer should always be open. And as we have it in practice at the moment, I should not be denied the opportunity to make an appeal if I feel grieved by the decision of the Commissioner. And if we leave it too open, it will create uncertainty, and agency notices can also be misused. We know they have been misused in the past. And we appeal that the deletion itself be deleted. It will create uncertainty, and agency notices can also be misused. We know they have been misused in the past. And we appeal that the deletion itself be deleted.
Yeah, honorable members, that section 4214 of the Tax Procedures Act reads 14, that the commissioner shall not issue a notice under this section unless A, the taxpayer has defaulted in paying an installment under section 32.2, the commissioner has raised an assessment and the taxpayer has not objected to or challenged the validity of the assessment within the prescribed period. C, the taxpayer has not appealed against an assessment specified an objection decision within the prescribed manner. D, the taxpayer has made a self-assessment and submitted a return but has not paid the taxes due before the due date lapse, or the taxpayer has not appealed against an assessment specified in a decision, the tribunal or court. So yes, this is quite phenomenal, the deletion of that section. Maybe, KRA, what do you think, what was the intention of this section 4214 from KRA's perspective?
Thank you, Chair. The main reason why this proposal was made is because sometimes the twin a case in a tribunal, but there are no stop orders from the court to stop KRA from instituting and the taxpayer would go to court, but the court will not give orders stopping KRA from enforcing. So unless we have an order stopping us from enforcing and proceed, and that is why we deleted that provision. Yes.
So you're saying after now the tribunal rules in favor of KRA,
yes,
you are not able to enforce that decision because someone goes to court and gets a court order stopping you from collecting, from giving an agency notice.
Yes, we are saying if there is no court order stopping us, then we should enforce.
Okay.
Yes.
Just a response.
What do you think, CPAs?
Yeah, Chairman, and with tremendous respect to my colleague there from Kenya. Yes.
When people start saying they give you tremendous respect, you know what that means.
Yeah, Chair, the concern is really one that have been assessed by a revenue authority. We have gone to the tribunal, we have appealed, and the tribunal has found in favor of the revenue authority. I, as a taxpayer, even under the Tax Appeals Tribunal Act, have a right to appeal to the High Court. However, what has happened in practice is that Kenya Revenue Authority, immediately you get a decision from the Tax Appeals Tribunal, they send you an agency notice. And so I have to run to the High Court to get a stay order. So what we are requesting in this proposal is, once I notify Kenya Revenue Authority that I am appealing against the decision of the Tax Appeals Tribunal, then Kenya Revenue Authority, please do not issue an agency notice. Because that is the danger there, that we shall be getting decisions, and as a matter of practice, these decisions actually come on Friday afternoon, Chair, from the Tax Appeals Tribunal. So on Monday, you wake up finding that you have an agency notice, and I did not even have time to appeal. So, and actually the proposal, Chair, there is, if you look at the Public Procurement Appeals Review Board, they actually have a provision which says, do not enforce this decision of the board until the period of appeal has lapsed. That really is what we're asking for.
And what is a period of appeal?
30 days.
30 days, eh? That will give still the 30 days period. And at the lapse of the 30 days period, then an agency notice can be issued. So that way, the taxpayer has been given a chance to appeal, and if the term lapses for them to appeal, then they have no one to blame.
And maybe, Chair, to add to that, even for us taxpayers, we are very keen to ensure that we appeal within the 30 days. Because if we know if we don't appeal within that period, actually the agency notice can be issued. So I think it's really, really important that the 30 days that a taxpayer has to appeal. And think about it. What happens in instances where, for example, it's the taxpayer who has won at the tribunal seeking for a refund from KRA? We never go to follow up on that refund immediately if we know that they have appealed. So I think it is fair that the right to appeal, since it is due to the taxpayer, be kept open. No agency notice can be raised during this period. Thank you.
That's good. Proceed. Make progress.
Thank you. Thank you, Chair. 35. My colleague, Christine Kahema, will do number 37. 38. The number 35, Chair, relates to, in the Finance Bill, a proposal to delete the provision that provide for withholding tax and says that it shall not apply to the taxable value of zero-rated supplies. We strongly recommend that we retain the current provision. And why? Because businesses that are already dealing with zero-rated supplies and manufacturers are already in perpetual refund position, many of them. And number 36, the proposal to amend Section 32 of the Tax Appeals Tribunal Act by inserting the following words immediately after the High Court. There. Now, our recommendation, we amend Section 32 of the Tax Appeals Tribunal Act by inserting the following immediately after the words High Court, failure to which the decision of the tribunal shall be final and binding on both parties. Again, to be fair to both sides, to ensure that the provision is not misused and also ensure adherence to Article 47 of the Constitution and of this country and justice. 37.
Yeah, I think 37, we had already dealt with it. 38 is on the appointment of withholding VAT agents and the permission of the withholding VAT within 5 days. And Chair, this has really, really increased the compliance burden. And I will look at this twofold. Almost everyone now is being appointed as a withholding VAT agent. I mean, taxpayers have been complaining, and previously the commissioner had powers to rescind the appointment. But now that doesn't happen, meaning that as soon as you're appointed a withholding VAT agent, you must start complying. Now, you have to do this and remit the tax within 5 days. It has significantly increased the compliance burden. You can imagine for a supplier who may just have one invoice received at different instances, they need to withhold and pay it. We are asking that that be remitted before the 20th of the following month to ease on compliance. The emergence of e-teams, because when withholding VAT was being introduced, it was supposed to increase the tax base, notify the commissioner of existing taxpayers who hadn't been complied because their VAT was being paid in advance at a certain rate. With e-teams, do we really, really need to still have withholding VAT as a system in Kenya? If that is still to be there, we are asking if remittance of this to be done by the 20th of the subsequent month. Thank you.
Thank you, Chair. That is the end of our miscellaneous presentation. Back to the Chair.
Thank you, Senior FCPA Kwaka. I give it to FCPA Georgina Malombe to take us through other proposals that the Institute has looked at and may make a few comments here and there.
Thank you, Chair. I think we have 3 additional other proposals for consideration, and the very first one is on withholding tax. We are aware in the Finance Act of 2023 there was an amendment of the Income Tax Act to introduce a requirement that taxpayers remit withholding tax to the commissioner within 5 working. And the issue here is it has been so burdensome to institutions because this can be issued on a day-to-day basis. And I think one of the canons of taxation is that it ought to be easy and very convenient. And therefore, to echo what my colleagues have said on the same length, is to harmonize the due date of the payment of withholding taxes to 20th. I know we had put it on to 10th, but further consultations, we are saying anything withholding, we should harmonize it to 20th. And there are so many benefits to it. One is to reduce the cost of compliance, which is in our initial submissions, we said we have to create an enabling environment for businesses to thrive. And number two, the issue of rethinking on a day-to-day basis needs to be considered. Our submission for your consideration, number two, Chair, is on the expansion of the pay-as-you-earn bans. Of course, 2023 Act, Finance Act 2023, it introduced new bans, and we've already highlighted them there. What you're saying is that these bans are very narrow and extremely steep. And when you look at what is happening, the progression from 32.5%, 35%, that is quite steep. And this may point to excessive taxation, which potentially erodes the purchasing power and ability for individuals to save. Now, when you look at one of the key aspects was to safeguard the hustler economy. Look at anybody who is earning anything 32 from 1 shilling to 32,000. Those fall under the hustler category. And you are saying if we can be able to increase this band to almost 48,000, that would be good. But we are leaving this open for you to consider that. And this also, the increase of this lower band will also make Kenya competitive and also increase the disposable income, which has already been consumed through other taxes. And lastly, the last concern is on last respect benefits. When we are paying terminal dues to the next of kin for the independents, we are proposing we waive taxes on those benefits because the breadwinner is gone. So we are saying let us not tax citizens to the grave, Chairman. Thank you.
Thank you very much, FCPA Georgina. That brings us to an end our submissions from the Institute of Certified Public Accountants. But Honorable Chair, our prayer is let's not complicate tax. In doing all this, it shall be leading to tax avoidance, tax evasion, and compliance costs will just be so high to a level where we may not be able to also really refocus our efforts also not on just the finance bill and the revenue raising measures, but also on the expenditure side. Make a budget that can be reasonable, that we can be able to many meetings as a committee, as an institute. We were just wondering the deficit is now around 500 from 9. And if we were to reduce some of our expenditures so that our deficit comes down even to 200 and we are able to finance it. Corruption and revenue leakage is something the Institute takes a lot of concern with because the citizens keep on wondering, even as we pay, what are we getting? And so this is an area we should also be really looking at. And with that, we have finished our submission, but overtaxation does not grow our economy. Instead, we have already seen that the more taxes you you impose on the people, the less revenue you collect. So it is better to go the other way around. Thank you very much, Chairman and the honorable members, members of the Fourth Estate for listening to us. Thank you.
Thank you very much. Are there any questions or concerns from our members? Honorable Boni, then Makida.
Back for that good presentation. I think the moment you do presentation every year on the finance bill, I'm reading myself. So, but I have one or two concerns. One, %5% with the tax. And you did mention that this one is going to drive away foreign direct board of foreign investors. They want to be investors as brought into that board. And have you also considered in the money market, which is with all these taxes 15%, and I believe also foreign investors. Why you concerned investors? Why you concerned with infrastructure board and not the money market, where money market and also the Nairobi Stock Exchange, and I think Nairobi Stock Exchange. The foreigners there, they are around 20%, 80% are Kenyans, and they are still paying withholding tax. So have you done some analysis on that too? This is what Chair was alluding to on clause 6 on the benefit to public sector employees. You know, public sector employees are paid very poorly compared to you people. You know, I've seen some of you, like my friend here. The first time he came to this committee in last parliament, he was very thin. Now he looks better. That means there's something in the pocket. Why don't you want public sector also to benefit? Because even private sector, you have policies. You have HR policy. How do you reward your people, right? And I know some of you are working in private sector. You have car loans. In fact, yours is even not, I know some companies where they give you a car. You use it for 5 years, and they give it to you for free. Give it free to you. So why do you really get concerned with the public sector? Because the money is from public. Thank you.
Let me not see. Hello, Makila.
Thank you, Chairman. Your accountancy. You actually, whenever you make your submissions, I get a lot of information, I get a lot of knowledge. Dealing with other people who will come before you, after you. My take is that in using your own words, Chair Isbag, or the CEO of Isbag, what is it that can be done? Because you've said in your own words that the more we levy for taxes or we overburden taxes, the more they don't pay. They run away, they find some innovative ways on how to invest. What suggestion can you provide to this committee that will make administration of tax friendly and people will be able to pay without really inventing a lot of ways on how to run away from taxation? secondly, the proposals that we have has a lot of penalties for, non-collection of tax, penalties on withholding of tax. There is always penalties to citizens who may not be able to, pay the taxes as expected. But what suggestion do you have to now organizations like KRA, if they fail to pay a citizen for refund? There's always timeline for paying. It takes 1 to 3 days. But what about if the person that maybe you overpaid, there's tax refund, there is no penalty, they delay paying you? Why is it that penalties are on one-way direction? Can you give a suggestion also that if a businessman is being defaulted by KRA and is not being paid money as expected, what is his penalty? Because in the spirit of fair trade practices and in the spirit of fairness and administration of justice, then when you penalize this direction, but if you are also being mistreated on this direction, there's also penalties in the other direction, so that there is mutual understanding. What is your take? What do you think can be done so that there is respect for the contributor and there is also respect for the person who is collecting the money, so that there is fairness in this country? What is your thinking? Because you are experts on these particular matters. I think that is my case.
Thank you, Honorable Makilab. I think I got to ask most of the question that I would have asked. But on this insurance services, we were struggling earlier to find out what these services, the insurance services, insurance companies charge, and what percentage of that is it in their business. So that we're looking at this is their input. So what are these services and what percentage? So you see on those ones. Then what I have continuously said is, especially because taxes touch on us individually, we get very concerned, and we take time to prepare our submissions and explain them and get examples and get comparative analysis. But as you said, I wish we'd do the same on the expenditure side. And show you how we don't do very well there. In your presentation, you note that the budget for 24-25 is 4.2 trillion shillings, which is not the case. The 4.2 trillion shillings was what was in the BPS, but that has since been revised, so the estimates that were tabled at Parliament, the National Assembly a few weeks ago, the budget is actually 3.96 trillion. So they're really around 260 billion shillings that has been taken off of budget already. So that's why maybe we don't take much keen interest on the expenditure side as we take. I'm sure you not get any of the. You did not misquote any of the levies or any of the taxes, but the number for the budget you got it wrong. And I'm wondering if you have made such a candid presentation to the budget committee as well, when they are doing their public participation and estimates. How about you, Chair?
Thank you. Before you, there's a list. I think it came from you. I'm just looking at it. This list came from ISPAC?
No. That's
okay, sorry.
Proceed, Chair.
Because it was really worrying me.
Thank you, Chair. Thank you very much, honorable members. And thank you very much for the compliments and the questions seeking clarification. I'll start with the Chair first. We know that there was a revision from 4.2 to 3.9. So that's just a typo. We picked the 4.2 from the budget policy statement, and we have looked at it in a different submission. I think this was just a typo. We know that it came down after the budget estimates were brought to the National Assembly to 3.9. We also know that the deficit, the current year after supplementary is 908 billion, which has now reduced in the current budget estimates to around 500. So the figures, we know them, Honorable Chair, and in our submission to the budget committee, such an error cannot occur. So these are just introduction, but nothing like an error. Number two, I would want to give
Did you appear before the budget committee?
We are yet to.
Do you usually?
Yes.
Okay. When? Because I think they're almost finishing their public participation.
We did our submissions already, but we haven't appeared as in.
Is there someone from BPO? Apart from Judge seems to be more of finance than BPO.
Okay.
When is the budget committee finishing their submissions? Eh? So actually, it will finish today. So the budget committee is completing their public participation on the budget today. So you've not been. Judge seems to be more of finance than BPO.
Okay.
When is the budget committee finishing their submissions? Eh? So actually, it will finish today. So the budget committee is completing their public participation on the budget today. So you will not be happy.
Okay. Okay. We may cross over, but so our submissions already were received in written, and they are detailed enough to cover all these areas, including free education and bundling the governments and the national governments. And we've seen the mediation committee has sort of sorted that matter. So we are well aligned with the figures. Honorable Chair, I can assure you, with the figures, we are more aligned than even these legal matters, which of course touch us. So, Honorable Chair, allow us to make a quick response to some of the clarifications that have been sought, and I'll give FCPA Robert to run with that area of questions. There are actually 1, 2, 3, and there are sort of 5 questions, which I'll give not honorable as such, FCPA. When you grow up, you'll be honorable. FCPA Robert to run with that very quickly. Clarify, please.
So, Robert, which constituency are you running so that I link to my colleague?
Honorable Chair, fortunately, I do not have political ambitions right now from Molo. Yes, so very quickly, starting with your question, Honorable Chair, the question on insurance, the proposal on insurance, actually that it's deleting the current exemption for insurance and insurance services and now just replacing that with insurance premium. What that means is that, for example, if I run a brokerage business and I get a brokerage commission, or I'm a life agent and I get an agency commission, I actually have to charge VAT on that. And that's the problem that this sector will face, because as it is, insurance penetration is about 2.3%. If you now ask our life agents to start charging us VAT, then chances are that not many people will do that. So whereas premium is exempt, everything else along the insurance value chain would be subject to tax. And that's really the key issue that we're saying. And we're saying, let us just exempt the entire insurance ecosystem other than what is currently provided.
So like the actuarial services, the management fees, consultants fees, all those now will be vatable.
Those are already, actually, as it is, they're already vatable. They're actually already excluded. So it's a very subtle proposal, Chair, that is saying, from an insurance perspective, we'll tax everything other than premiums.
So what you're struggling with is, what is this list of everything?
so that we look at the implication of that. Morris, you want to weigh in?
Thank you, Chair. I really feel a bit uneasy arguing with this part because I'm a member. But the issue is, Chair, Chair, FCPA, Robert has put it very clearly that most of the insurance services are actually vatable. The only thing that was not vatable then, and we are also proposing that it should not be vatable, is the premiums. So these other services, because as he has mentioned, the issue of the management fee, including even loss assessment, are already vatable. Probably the only fear is the brokerage services. And I think it needs to be made clear that brokerage services is actually the one that is remaining. And I really don't think that that should be a big issue. Yes. It's not expressly there because we also need to ensure that there could be some other services that we may not know, and it is important that they are covered.
So now, which is why I've been asking since yesterday, what are these other services? I was hoping you could tell me it's 1, 2, 3, 4, and so that we're able to see what is the import of vetting them on the insurance sector. So maybe yourself, or if you can talk to your, is it the insurance association or something? Or they're coming up with an hate from the insurance themselves. Okay, thank you very much for it. And you're not arguing with them, it's just, it's a good idea giving life to a better idea, and a better idea giving life to the best idea. So if you are afraid, then I should be very, very worried.
Yes. By Honorable Board and investors. And that's data that we can certainly provide as we give this paper. But however, we do take the point around 15% withholding tax is payable on interest to foreigners. The only thing we are saying is that given our current circumstances, the cost of borrowing in Kenya, the government borrowing in Kenya, which squeezes out or crowds out public sector, which makes these foreign options a better one. So that's something that we probably can provide data around the statistics. On the issue of public benefits and the public sector, Honorable Chair, last year when we appeared before you, we made very spirited attempts or proposals that this proposal be dropped last year, and thankfully you did drop it. So we hope that you're also going to drop it this year, because essentially the concern here is public sector employees may end up getting benefits that are not subject to tax, and therefore we're eroding our tax base, these exemptions. That really is a concern. And the other concern here, Chair, is if we do that, then I think we are going for who gave that. People who are paid use assets, it's not taxable. And what are we doing to our tax base? Really, that is a concern. Then, Honorable Makilap, I agree with you. There is actually, if you look at the Tax Procedures Act, there is a provision that allows that permits taxpayers to claim interest from of unpaid refunds. However, the way that provision is worded, it's impossible to trigger it because the commissioner has to confirm. So they'll never confirm that they owe you, so in which you'll never get any interest. And I think really one of the things that we have to do as a country is have a holistic view, Chair, and say, can we have a look at the Public Finance Management Act? Because the challenge for Revenue Authority to pay these refunds is because they don't have the funding. Because the challenge for Revenue Authority to pay these refunds is because they don't have the funding. And that's because all funding goes to the Exchequer. So for it to come from the Exchequer, it needs approval. But we're saying if the Public Finance Management Act, I think it's Section 15, can be amended to permit Revenue Authority to retain a portion of the funds collected to settle refunds, or to allow, prior to 2013, we actually had automatic set-offs. So if I had an overpayment, then Revenue Authority can come and audit me 1 year, 2 years down the line, in the event that I have underpaid, I'm happy to pay the penalties. And I really think to support businesses, this is something that we need to bring back so that it's very clear that cash flow is not constrained for businesses, because that is really the problem. And we thank you for the proposal to defer the income for public supplies. And I think this is the steps that we need to take as a country to support businesses. Chair, I don't know whether there's motivation for paying taxes. Yes, friendly tax collection mechanisms. They tell us that my good friend Maurice Oredia says that they're not in the business of laughing with taxpayers. If they laugh, nobody will pay. So I honestly speaking, Honorable Makilap, if we can demonstrate the public benefit that we are getting from paying these taxes, so that I don't have to pay school fees, I don't have to go to pay medical costs. If we can demonstrate that, I don't believe Kenyans have a problem with paying taxes. However, as it is, we didn't discuss this, Chair, but if you look at this eco-levy, we are taxing the batteries, we are taxing the tires, we are taxing the motor vehicle. The next thing we'll do is that we'll have heart tax as well. I think we just take a break from raising these revenues, and I agree with you, reduce our budget, and then whatever we are collecting, let us it properly so that taxpayers can actually see the benefit, and that way we won't have revenue authority chasing all of us to try and pay the taxes.
Thank you. So thank you very much, Chair of the committee, the Honorable Kuria, and the Honorable members. Thank you very much, my team from ISPAC. On tax motivation and why we should pay, Honorable Chair, it has reached a point where, especially the salaried, now you've raided them completely, introducing even the motor vehicle, and where they have to go and pay their premiums from the little that has remained. And the joke out there, Honorable Chair, is that just pick all, take the salary and now pay for me what I have to incur. If I want to eat, let the government pay. If I have to take my kid to school, I come. Because now if you have been taxed to a level where now even the Employment Act of a third rule does not apply, then what do you have? And the same now you follow it, of course, with VAT in the shops and everywhere. So the joke is, if I'm earning 100,000, let me give it to Honorable Kimani. Then when I want to take my kid to a private school, I come.
Why are you giving it to me? Give it to Kenya.
Yeah, but we take note of your concerns and questions and compliments and clarifications, and we shall harmonize our document and submit to your team the right time. But we also take note of our participation in the Budget Appropriation Committee, and we shall endeavor to follow up on this, because we submit, but we rarely get to appear like we do appear before this committee and other committees of Parliament. So thank you very much. We appreciate the time we've been given as an institute to make our submission to this committee, and pray it is serious public participation. Honorable Chair, thank you.
Thank you very much, my Chair. And
I needed to make a disclosure that CPORA is a member of the Public Finance and Committee, Tax Committee of ISPAC, but when he's here, this submission he has not participated because of conflict of interest, but he's our member and a member of PFT. Okay. Thank you.
Thank you very much. It's to really thank you. I honestly really thoroughly enjoy the conversations that you have with ISPAC. You take you're giving us alternative. What is the alternative and justification? And even you go out of your way, and and like our friends in Deloitte and PwC, where they have your views as being very, very balanced. And last financial year, this committee has been accused of saying is the public participation on excess and futility. And I think you should be one of the people who should be going out there and saying, like, we actually feel there were very many recommendations that you brought that we took along. You explained to this committee the difference between when you exempt the why going on than it being on exempt, and we made a lot of changes that some people were saying that they saw the impact of that in the business and the economy, and some of those proposals, including this advantage to civil servants that would otherwise accrue benefits to us, because the proposal now to exempt that benefit that we're given to own a car, notwithstanding that the car is actually used, I think mostly to target public servants, and by and large, members will not take, even when that amendment would have been. We endeavor to make public participation not just an exercise. We just pick one or two items and make us about the 2 or 3 items. And I'm very happy and that we have bread and motor vehicle. There are so many other, some of those very good proposals, some of them during our report. So let's not make this about just 1 or 2 items. Let us holistically and critically critique the document, and where possible come up with better recommendations so that we come up with a good law. I thank you very much, and we had a very good engagement the other day at your seminar. You like putting me on the hot seat, but it's okay. I can take the heat. Asanteni sana, and wish you all the best. That's up to you. You convince him to take CPA exams. Deloitte, how long do you need for your presentation? 1 hour. I thought you were in the in the ISPA committee, so that will take. Okay, go on. Maybe make it 30. Make it 30, and then please bring both institute, the Institute of Economic Affairs and Public Finance Institute, so that they're listening.
I was wondering whether Kwame is. Now I can see him. Good afternoon, our honorable members. Good afternoon, our stakeholders. So this is the public participation on the finance bill of 2024, and so we've left with Deloitte and Touche. We have Institute of Economic Affairs. We have Public Finance Institute of Public Finance. So I've asked that you all sit in, so that matters that have been canvassed, then you do not have to belabor on them in your presentation. And over to you, and then you can take a quick round of introduction. So when it's your turn, then we just go on to your submissions. And then, we did ask that you give us the written submission particular format. So if you could kindly share them with us, so that we can also be going through them. CPA Kimogo, your turn. Introduce yourself, and then over the mic to everyone.
Sorry. Good afternoon, Chair. Good afternoon, members. So my name is Fred Kimodo from Deloitte East Africa. I have my colleagues from Deloitte. I'll allow them to introduce themselves. Thank you.
Yeah, Chair and members, I'm Patrick Chege from Deloitte.
Chair and honorable members, I'm Lucy Kereka from Deloitte.
Chair and honorable member, I'm Esther Muteti from Deloitte.
Chair and honorable members, I'm Emmanuel from SC Johnson.
Good afternoon, Chair and honorable members. Kennedy Okoye from Deloitte East Africa.
All right, Kwame, introduce yourself and your team.
Good morning. Good afternoon. My name is Kwame Reno from the Institute of Economic Affairs.
Good morning. My name is Julie Washira from the Institute of Economic Affairs.
I know it's supposed to meet in the morning, but it is way past midday.
Chair and honorable members, my name is Raphael Muya from Institute of Economic Affairs.
So Public Finance Institute, they here. Now, so introduce yourself, sir. Go on.
Chair, my name is Edwin Wanjao from Deloitte.
Good afternoon. My name is Veronica Ndegwa, Institute of Public Finance.
Good afternoon. My name is Daniel Murakaru from the Institute of Public Finance.
Okay, over to you, Mother from Deloitte.
Yeah, thank you. We have 3 sets of submissions. 2 of them are very, very brief, Chair. So with your permission, we'll start with the submissions from SC Johnson. It's basically 1 submission. We'll then go to the submissions from Deloitte East Africa, which we are doing on behalf of most of our clients and the taxpayers. And then we'll do submissions for DFSAC, or Digital Financial Services Association of Kenya. So with your permission, I'll give the microphone to Emmanuel, who is the country manager of SCJ, just to give us a brief background of the proposal that we are seeking to have amended in the finance bill. And then Kennedy Okoye will take us through the very specific provision. Over to you, Emmanuel, through your chair.
All right. Thank you, Chair.
Hold on. Do you have the written submission for
SC Johnson?
SC Johnson.
All right. So in brief, SC Johnson is a global company that is leading in pest control. But in Kenya, and in line with the request that we've come today, we are in a journey to try and fight malaria, which is in line with the government of Kenya malaria strategy vector control intervention. We are investing over $10 million, which is close to 1.5 billion, in expanding our facility in Kenya. And the reason for the expansion is to produce low-cost repellents that will be provided to low-income communities for free. And the reason for this is one of the big goals for SC Johnson, which we have aligned together with the Ministry of Health, is to try and contribute in combating malaria. The low-cost repellents will reduce disease transmission, get them through the public health channels to help us protect more families, and there's no profit that's going to be driven, that's going to be made out of this investment through SC Johnson. All of it is not for profit, is only to contribute to the initiative to fight malaria. And what we are requesting is for the purchase of the equipment that is going to be used to produce these low-cost repellents, is we need the VAT on them to be excluded. But the team from Deloitte will expound more on this.
Yeah, thank you, Chair. As mentioned by Emmanuel, and SCJ expresses its gratitude with the government efforts to try and help it produce this low-cost repellent. Specifically, the government has proposed the introduction of paragraph 148 of Part 1 of the first schedule of the VAT Act to exempt and raw materials used in the manufacture of mosquito repellent upon recommendation by the Cabinet Secretary responsible for health. So what SC Johnson is requesting is just a little expansion of that paragraph to include machinery, such that when this machinery that will go towards expansion of the high-speed lines for manufacture of these mosquito repellents come in, they do not suffer VAT, because if they have to pay VAT, that will squeeze the liquidity available for this expansion, and in turn reduce the capacity and the number of the repellents that will be issued. One thing that Emmanuel has mentioned is SC Johnson. They do not suffer VAT, because if they have to pay VAT, that will squeeze the liquidity available for this expansion, and in turn reduce the capacity and the number of the repellents that will be issued. One thing that Emmanuel has mentioned is SC Johnson on preventing the transmission and contraction of malaria. We do appreciate the government has already put in place measures to provide relief in terms of taxes on the drugs with anti-malarial active ingredients, which then are used to treat malaria. SC Johnson wants to come in earlier to prevent, because it realizes is to expand that to read inputs, machinery, and raw materials used in the manufacture of mosquito repellent on recommendation by the Cabinet Secretary for matters relating to health. Thank you.
Thank you, Chair. Those are submissions from SCJ. With your permission, we can move to the next set of submissions, Chair. Unless there is any question from the honourable members.
Mr. You have a quick interjection?
Is it already? It's already existing in the bill, and your request is to, in addition to inputs and raw materials, you need to add machinery. Is it in the bill or in the act?
It is in the bill.
Okay. Honourable members, page 571, clause 148 of the bill. It says, part U, by inserting a new paragraph immediately after paragraph 147, 148, inputs and raw materials used in the manufacture of mosquito repellent on recommendation by the CS responsible for matters relating to health. So it is saying
inputs, so they want to add input, comma, machinery, and raw materials. The addition of machinery. Okay, proceed. And I think that you've made your case. So next presentation.
Thank you, Chair. You'll allow Emmanuel to leave if that is okay with you.
We leave at your pleasure. You know, our parliamentary sittings are open to the public, so I may not ask them to leave. Cannot tell them they can leave at their own pleasure.
Right, thank you, Chair.
Karibu, all the best.
Thank you, Chair. We move swiftly to the next set of submissions from Deloitte East Africa. We will start with our submissions from an income tax perspective, which will be taken through by Patrick Chege.
Thank you. Chair, under income tax, we have very few proposals, and I'll go straight to the first proposal. Is to clause 9, the introduction of motor vehicle tax. Chair, I know you have had a lot on this issue, and therefore I'm not going to rehearse a lot. I'm just going to mention the areas that I wish there to be some kind of changes. One, the bill proposes at a rate of 2.5% of the value of a motor vehicle, subject to a maximum of 5,000 shilling and a minimum of 5,000 shilling and a maximum of 100,000 shilling. So the other aspect is the corrector will be the insurance companies, and more importantly, an insurance company for what's in the correction will be subject to 50% penalty. So I'm only going to touch on the two areas. Now our proposal is the reduction of the rate from 2.5% to 0.5%. Yeah, so that's our first proposal. Our second one touches on the floor amount. So we are proposing that the minimum tax that should be levied on one particular motor vehicle, the minimum should be 1,000 shilling at a maximum of 20,000 shilling. So we feel this penalty is too punitive, too high, and because this provision has been brought through the income tax, we are proposing that the penalty should be aligned with those penalties provided for under Section 83, Capital A of the Tax Procedure Act 2015. That's the 5%. In terms of justification, I'll just state 3-4 points. Number one, taxing motor vehicle, first of all, is not even a good idea. But if it has to be there, it's important to recognize the fact that upon importation of a motor vehicle, excise duty was paid on the value of motor vehicle, VAT was paid, IDF was paid, RDL was paid, and import duties were paid. All these were paid. And basically, most of these vehicles are not even commercial vehicles, they are personal vehicles, and therefore it's important to take into account that all these taxes have been paid, and levying 2.5% of tax will be too punitive for the owners of motor vehicles. Maybe the other alternative to that submission, Chair, is maybe this committee to consider possibly imposing just a 2 shilling road maintenance levy in fuel instead of going for a particular charge per motor vehicle. Just increase the road maintenance levy by 2 shilling and forget about this tax. That way, we're able to collect this tax in a very, very efficient manner, and it's likely to yield more without much litigation from in a quarter, and not even affecting some of the sectors like the insurance, which we expect it to be impacted for, adversely. So that's the first one. The second one, Chair, is at clause number 5, I've said to skip clause number 23, clause 5, and this is the introduction of withholding tax on supply of goods to government. So the bill proposes that whatever payments that we made for goods supplied to government, those payments should be deemed to be income of the person doing the supply for that year of income when the payment is received. And there's no problem with that. The problem comes when a 3% withholding tax is imposed on the resident person and 5% on a resident person. So what we feel is that this is a high, and we are proposing a reduction to 1% for resident persons and 2% for non-resident persons. And the reason why we are proposing this, honorable members, is because, number one, if you look at most, they are always complaining of late settlement of their money, their dues. And because of that, they incur a lot of interest. So that interest goes to eat the margins. So most of the suppliers to government are faced with very, very small margins. That's number one. Number two, already these are people who are in the radar of KRA, and given that withholding tax is not final tax, they will still be able to pay additional tax when they are filing the return, in case they make a margin beyond 1% and 2%. So in terms of cash flow, that will help them. So we feel that 1% and 2% for resident and resident persons should be sufficient. Our submission number 3 is on clause number 23C and 25B3 capital A, and this taxation of government infrastructure. Our submission is that they should be done away with, so that to invest in this sector. So
sorry, where are we?
We are at page 4, item 4. Page 4. Item 4. I was discussing clause number 23C and 25B.
So on clause 23C and 25B.
Yes.
Okay.
Yeah. So in the alternative, then what we are saying, if this tax must remain, then for the resident person, the 5% should be made a final tax, such that there should be no further taxation. We go to page 5, and it's item 5, which is clause 25B3C. And here, the bill proposes to scrap the 24,000 withholding tax threshold, which is applied on management or professional fee or training fee. Now, Chair, the issue with this issue is that thresholds are set so that you don't operate tax on a transaction that's not economical. And if you recall here, when the national tax policy was being presented, there was a clause in one of the pages that talked about the principle of the de minimis non curat rex. It is there in the tax policy, and the commissioner should. So when you place a threshold of 24,000, which is in aggregate, per month, it's a very, very small pay, because this could be 3-4 payments. If you take, for instance, 24,000 and apply a rate of 3%, because these payments would be subject to either 3% or 5%. So you take 3% of 24,000 is only 700 shilling and 720 shilling. If you take a rate of 5%, it's 1,200. So if you look at those two amounts of tax and the administration cost of maintaining those accounts, the administration cost could even be higher than that. So, and therefore, scrapping this kind of a limit is likely to run us into a situation where the cost of running tax is more than the tax yield itself. So we go to clause 8, same page. This is the digital service tax, which is to be placed by significant economic presence tax. Chair, here what the bill proposes is an application of 30% of the tax rate on an assumed or deemed 20% profit based on gross turnover. What's the issue here? The issue here is that if you apply 30% on an assumed profit of 20%, is like applying a 6% withholding tax rate on the gross amount. That here is too high, considering that this same or similar tax was there before at 1.5%. We propose that this rate could be brought down from 30% to 5%. To 5%, so that the effective tax rate now becomes 1.5%. So if you take 5%, you multiply by 30%, you get a 1.5% effective withholding tax rate. So that is what we are proposing. And the second proposal, in addition to this, is you realize that significant economic presence is not, it will be very difficult for even taxpayers to comply with this. Because if you are just allowing me, these are normal taxes on non-resident persons. Persons who are not registered in Kenya, they have their registration in another country. When they have some significant presence, they become what we call PEs, permanent establishments or branches. And they are taxed at a very elaborate system of taxation exists under the Income Tax Act. Now, we are talking about those who cannot qualify to be permanent establishments in Kenya, but have some sort of presence. So that presence is not defined, and it requires to be defined. So what we are proposing is to have that defined in terms of the size of the transaction. So what we are saying is that we should have a threshold of at least 10 million. So that then you'll be said to have had a significant economic presence in the country. So other than that, it's going to be very, very difficult even for taxpayers to comply. Now we go to...
So maybe what will be your proposal to further define significant tax presence? Would you propose a threshold like you have on VAT?
Yeah, if you look at the same submission, we have proposed a revenue, annual revenue of at least 10 million. Yeah. 10 is a figure we can work with, and that can always be revised based on in a further evaluation. Yeah, Chair, now we go to personal income tax, and my colleague Lucy will take you through.
Thank you, Mr. Chair and honorable members. I will be covering the personal taxes section. We are on point number 7. Clause 6B, subsection 2 of the Finance Bill proposes reimbursement on expenditure incurred by public officers on official duties. So what the bill seeks to propose is that these amounts be exempt for expenditure incurred for the purpose of performing official duties, notwithstanding the ownership or control of these assets that have been purchased. So our recommendation on this is, 1, we recommend that this clause is deleted in its entirety, and it's not feasible. We recommend a deletion of the words, notwithstanding the ownership or control of the assets purchased, and the insertion of, provided that any assets so purchased and control of the public entity that is making that particular reimbursement. And or, I have another or, for purposes of obeying the principle of equity and to ensure that this is not discriminatory, we propose that the amendment should include all employees, to read as follows. any amount paid or granted to an employee to reimburse an expenditure incurred for the purpose of performing official duties, provided that any assets so purchased shall be under the control and ownership of the employer. Our justification of this is with regards to the, irrespective of who owns or controls the assets that have been purchased, we will be creating avenues or opportunities of public funds being misused through the purchase of private assets for individuals. Further, our recommendation of this will remedy this by ensuring any assets that have been purchased with such reimbursements are transferred to either the public body, and in the event our second proposal is taken into consideration, the employer that grants that particular reimbursement. We will move on to the next point, which is under clause 6, section A, subsection 1, which is on the increase on the non-taxable limit of the per diem allowance. The bill seeks to make amendments to section 5(2)(a) P of the Income Tax Act by increasing the non-taxable limit of amounts that have been received by an employee, entertainment or other allowance in respect of a period spent outside an employee's usual workplace. So what the bill seeks to do is to increase that figure from the current 2,000, which is provided for again under section 5(2)(a) subsection 2, to 5% of the monthly gross earnings of the employee per day, where the employer has a policy on payment and accounting of these allowances. Mr. Chair, our recommendation of this, in addition to what the bill has provided for, is that we recommend an insertion of the following provision after the word profits in the Income Tax Act to read, where the employer has no policy, this should be capped at the higher of 5,000 Kenyan shillings per day or 5% of the monthly gross earnings of the employee.
Okay. Lucy, try to speak a little away from your mic like that. Yes.
Okay.
Proceed.
Okay, thank you. Do you want me to go again? All right. So, okay, I'll go back to what the bill proposes. So the bill proposes to increase that figure from 2,000 shillings per day to 5% of the monthly gross earnings of the employee per day. So our recommendation, in addition to what the bill has provided for, is that where an employer has no policy, this should then be capped to a higher of 5,000 shillings per day or the 5% of the monthly gross earnings of the employees. And our justification of this is that the current proposal will negatively impact employees who earn less than 40,000 Kenya shillings per month, because the 5% of the gross earnings is even going to be lower than the 2,000 that is provided for currently in the Income Tax Act. Further to that, the tax-exempt threshold of 2,000 Kenya shillings per day has been effective since National Treasury should actually consider running a periodic review of this to factor in costs that are to do with inflation. So I think that brings my submissions to an end on personal tax. Okay.
Yeah, thank you, Chair. So with regards to VAT, I understand most of our proposals have been canvassed. So I'll try to be quick. And Chair, the first proposal there is quite welcome, the inclusion of the time of supply for exported goods. So our submission is to make it very clear to avoid any, room for dispute with the tax authority, and define that the time of supply for exported goods shall be the time when the registered person is in possession of a certificate of export or exit notes and road manifests in the case of goods exported to the East African Community member states. So that will make it clear and avoid any disputes with the KRA. The second provision, it's on financial services. No need to stress it further. The proposal is to drop this suggestion of bringing these financial services to VAT for two simple reasons. Number one, it's likely to create disputes because the provisions that are already these financial services can be grouped under paragraph 1, part A and B of the first schedule, part 2 of the VAT Act. So deleting this will most likely create that dispute. And to be honest, financial services are already subject to excise duty at 15%. The understanding when excise duty was being introduced is because VAT was not levied on these financial services. There's even a proposal to revise this excise duty rate from 15% to 20%. So levying additional 16% on them will basically take the transactional taxes on financial services to give or take 39%. The next proposal which we are making, it's something, Chair, which you are very well aware about bread. Our proposal is to retain it at 0 rating, with a modification that all types of breads are 0 rated to at least maintain the cost if the suppliers don't raise the cost because of other economic factors. Chair, of interest there is another proposal, item 13 of page 12, the VAT treatment of inbound international sea freight services. So this proposal was passed into law via the finance, which 0 rated it. And what informed that particular provision being introduced was the dispute and very bizarre scenario that was witnessed between the carrier and taxpayers. How these inbound international sea freight services work is when you import your car, Chair, when it lands at the coast of Mombasa, when you are paying customs duties on that particular vehicle or any good, the freight service is included as part of the taxable value of this particular vehicle, this particular good. Now, if the freighter is a resident person, KRA goes ahead to this freighter and tells them, for that freight service, for the goods you brought and docked at the coast of Mombasa, we want VAT. So it was a scenario where the freighter is forced to issue 2 invoices. One, for valuation of custom purposes, for which customs duties, including import VAT, is paid. And 2, a separate invoice to the same person for freight service only. So this one disadvantages the resident freighters, the cargo consolidators, really puts them out of the business because definitely using them will be more expensive. They'll be issuing 2 invoices for the same freight to an importer. So then the resident customers will opt to use non-residents who then will not issue with those 2 invoices. So our recommendation is to retain it under 0 rating as it was introduced last year. And if that is not feasible, to qualify Section 14(1) of the VAT Act so as to read, provide a registered person in Kenya shall not be taxed on the supplier, but shall be added to the customs value of the imported goods and taxed as a duty of customs on the importer, which is already happening. Chair, I'll go to input tax deduction, and this specifically speaks to the restriction of input tax to be claimed on passenger motor vehicle, repair and maintenance thereof. Increasingly, we see farmers, tea farms, other farms that are very far away from residential places, do ferry their employees to and from the farm. The VAT Act currently prohibits them from claiming that input tax, whether they buy buses to ferry their employees from estates, residential estates, to the farms, to and fro, which is making them, the cost of doing business being high. So our recommendation is to at least allow such particular organizations, whether they are mines, which are located very far away from where people live, whether they are farms, flower farms, at least allow them to claim input tax when they purchase these buses or whatever modes of transport they're using to transport, their workers to and fro, and the repair and maintenance thereof. Chair, another one also relates to input tax deduction, which is very good idea. Currently, the law prevents people from claiming input tax unless the supplier or the seller has declared that invoice. A very good idea, which we support. The challenge is with the implementation of teams, which will give, has declared is not functioning as intended. It has some hiccups here and there. So our proposal is to at least allow buyers to claim input tax, provided they have requisite documentation, until such time these teams or e-teams will have been modified and is working as intended. Then you can limit claiming input tax to when the seller has declared that particular input tax. I'll pause there and hand it to Esther, who will take us through the.
Thank you, Mr. Chair and the honorable members. I'll be submitting 4 items under the Excise Duty Act. So item 17, which pertains to clause 9, that calls for the repeal of relief of excise duty on raw materials. So currently, section 14 of the Excise Duty Act provides where excise duty has been paid in respect of excisable goods imported into or manufactured in Kenya by a licensed manufacturer and have been used as raw materials in the manufacture of other excisable goods. The excise duty paid on the raw materials shall be offset against the excise duty payable on the finished goods. So this particular provision directly impacts on manufacturers who use excisable raw materials to produce excisable finished goods. So the impact on these will be towards its introduction, where when I bring a particular product or when I use it in my operations, I don't have to pay excise duty, or when I pay, I'm allowed to. So the removal of these means this cost has to be absorbed by someone. Number one, either by the manufacturer, or it's going to be transferred to the eventual user. Already, most of these goods that are affected attract high excise duty. So our proposal will be to delete these in its entirety. And also, when you look at section 14.2, it also provides for where excise duty has been paid in respect of internet data services by a licensed person who purchases the data in bulk for resale, then the excise duty paid shall be offset against the excise duty payable by that person on internet data services supplied to the final consumer. So for bulk sellers of data, they're going to be directly impacted. And our proposal is we still retain section 14 for the manufacturers and bulk sellers of internet to continue enjoying that provision where they're allowed to offset. Another proposal that we still have under these items, so where we are recommending section 14.1 to be amended by inserting the words. So raw materials, the raw materials which actually enjoy the offset, we are proposing insertion of the words and packaging material immediately. This is because a number of excisable packaging materials are used by these same manufacturers, and it has not been very clear whether they should be enjoying this relief or not, and it's been interpreted differently by different parties. So we want that clarity, and that's why we are making this submission for consideration that the packaging material should be included under this section. So the second item is the introduction of excise duty on vegetable oils of very specific tariff headings. These are touch on palm oil, sunflower oil. And how we are looking at it is that vegetable is a basic commodity in almost every Kenyan household. And the push towards this, or rather why we've seen an increment in its usage, is because of its low or almost non-existent cholesterol levels. I think as a country, we don't want to go back to an era where every medical case is associated with cholesterol. So 25% increment, and this is ad valorem rate. So ad valorem is simply 25% of the value that we are currently paying. So we are bound to see increment at 25%. And it's barely a year where factors outside our control, where we saw a shift of this price. I think this proposal is seeking to add another 25%. So we will be proposing on its removal, because if it's too high for a Mwananchi to afford this, then they'll definitely shift to other means, which again will be dealing with issues of cholesterol from a medical perspective. Then again, vegetable oils are also a raw material on some of the basic household commodities like soap. They are still the same items that are used. Bread, which is discussed earlier, is also getting a hit in this bill. So we are seeking to delete it entirely for people to continue enjoying their vegetable oils and their bread in the morning. Then there are two proposals that we are seeking. They are not in the finance bill, but we thought it's important to discuss them. So I'll brush them very fast. So the first one is the first schedule of the Excise Duty Act provides for excise duty on imported glass bottles. So the only exclusion is imported glass bottles for packaging of pharmaceutical products, provided that it shall not apply to glass bottles imported from any of the countries within EAC community. The current rate is at 35%, whereas this was a good move initially. The current market does not have enough capacity to produce glass bottles. At the moment, we understand it's only, and most of the glass we are getting actually outside EAC, which has resulted to increased costs of the excisable goods or any other good that is packaged by glass bottles. Given that we are very key to shift to packaging materials that are very environmental friendly, and glass happens to be one of them. And at the moment, the plastic packaging is at 10%. So you can imagine where plastic packaging, if I bring it, is at 10% excise duty, but for glass it's at 35%, where we don't have current capacity in Kenya. Then the question remains in terms of the climate action, where we are headed. So our proposal is to kindly consider to amend, where we'll be having even glass that is coming outside EAC not being subject to this duty of 35%. The last one is an issue around excise stamps. Regulation 14 of the excise duty, excisable goods management system regulations of 2017, they provide as follows. Under 1, and this is purely on issues of damaged excise stamps shall be preserved for verification by an authorized officer, and where manufacturer or importer of excisable goods cannot account for any excise stamps issued to him by the commissioner shall compute the excise duty and other taxes on the unaccounted for stamps based on the highest excise rate, value, and volume of excisable goods manufactured or imported by the manufacturer or importer, as the case may be. So on the third regulation 14.3, in computing excise duty in the case of unaccounted for excise stamps, the commissioner shall allow for wastage and damages which shall not exceed 1% of the quantity of the issued stamps. So the issue here is, when you look at regulation 14.1, there is that requirement where during your operations you have damaged stamps, you're supposed to keep them aside for verification by another authorized officer. But when you come down under 14.3, where assuming they got lost or anything happened to them, you are only allowed 1%. So what happens in this case, where the ones that you are able to account, whatever you are able to show the commissioner is way beyond the 1%, does it mean you still pay excise duty on stamps that you are able to, stamps that are able to be presented to the commissioner for verification? So we are proposing insertion immediately after 14.3 that reads, provided that a manufacturer shall be deemed to have accounted for damaged stamps verified by...
Hold on. So this new proposal is an amendment to the regulations.
Yes.
Even though they are good proposals, but then they cannot be done on the finance bill, because these are regulations. So, and regulations can go to the committee on delegated legislation. So the best we can do is we recommend to on our report or to KRA to institute this with National Treasury to cause this amendment to the regulations. Okay. But it's not possible you cannot amend regulation
That is well noted. Thank you.
Thank you, Chair. We are drawing closer to the end of the submissions by Deloitte. We are getting now to the tax administration. I'll present on 3 of the issues. My colleague will take 2 of the other issues. Then we'll be done. Now, I'm on page number 21, issue number 22. The crowds is crowds number 53. And I think this one, Chair, has been deliberated by the other group that was here. It is a proposal that is seeking to delete section 42, subsection 14E, which is basically then, if deleted, it is going to empower the commissioner to issue agency notices in instances where the taxpayer has not exhausted its channels to appeal against an unfavorable decision. And I think it has been canvassed by the other group, but it is worth noting that from where we sit, if Chair and honorable members, you can remember a provision that was proposed last year where taxpayers were actually required to pay 50% of the amount of tax that is payable before appealing at the High Court. We think that if this proposal is actually passed as it is actually passing that proposal using the back route. And it can even be very, very bad because the commissioner can even correct 100% of the tax that has been lured against the taxpayer. So the proposal is to retain the provision of ensuring that we tighten our laws. We are also recommending a slight addition to the provision that we have. And the proviso that we are recommending to have is that the taxpayer has not appealed against an assessment specified in a decision of the tribunal or the court in accordance with the timelines provided for under section 53 and 54 of the Tax Procedures Act. What that does is to ensure that even from a revenue authority perspective, you are also not left overly exposed. We cap this to 30 days. If you don't appeal to the High Court within 30 days, then the Commissioner has the right to go for you and issue the agency notices. So, Chair, we request that this proposal is actually deleted from the Finance Bill. Allow me not to go through the proposed amendment under clause 53. I think it's self-explanatory. It's just an issue of trying to reduce the period within which an agency notice will remain valid from 1 year. Our proposal is to make it 6 months. Now, on clause number 56, Chair, and I think also it was canvassed quite in a bit of detail, but just for the sake of the honorable members as well. So what this proposal is seeking to do is to say, if the commissioner requests for information and you do not provide, probably, for example, provide 90% of that information and 10% is not provided, the whole of that objection is deemed to be invalid, which is huge, because what then that means is that someone from the revenue authority may just decide to abuse this particular provision and ensure that they actually never issue objection decisions. So that's what we are against, and we are requesting that that provision is not introduced through the Finance Bill. And just to an assessment today, you have 30 days to do what we call a notice of objection. When you do a notice of objection, the commissioner has 14 days to come back to you and tell you, look, I've looked at your notice of objection, but I need information 1, 2, 3, 4 to be added. And the commissioner actually is supposed to give you 7 days under the law. So what this provision is now trying to introduce is that if you don't provide that information within 7 days, that your objection is deemed to have been invalid. Now, it raises even the question of, at what point do you even take yourself to the tribunal? Remember, you don't have any decision. So it is left to you to interpret whether it was actually deemed, because there is no communication. And that is why we are requesting or recommending that even if the objection is to be disallowed, there needs to be communication in writing from the commissioner specifying that I requested for information 1, 2, 3, 4. You only provided 1 and 2. As a result, I'm going to disallow item 3 and 4. And as a result, the taxpayer then will be able to move swiftly to the Tax Appeals Tribunal to seek redress. The other clause, Chair, is on clause number 57. that is basically seeking to, integrate e-teams to the data management reporting system provided by the KRA. I think this one has also been discussed. The issue that is here, million Kenya shillings penalty per month that is proposed, is untenable. It is too high, and any person who is actually able to pay this may not even be able to continue with business. So the request is that you review this penalty downwards to 5% of the transaction value. Remember, the main reason as to why this particular provision is being introduced is to ensure that people do integrate. So we ask ourselves, what is the purpose of integrating? It's because the Revenue Authority want to have visibility of the transactions that these taxpayers have. So then we think that basing the penalty on the invoices that you have generated during that period that you are not integrated illegally, then would be a more reasonable penalty to have, in which case then we recommend that it is the higher of the 5% or 100,000 is the lower of the 5% or the 100,000 Kenya shillings. Sorry, I think it's whichever is higher. So I think that one is worth looking at. And the other thing also to note, the way the penalty is worded at the moment, it almost appears that it is at the discretion of the commissioner to determine whether it is 100,000 or 2 million. It's like a ledge that has been given. So in other words, if those powers lie in the hands of the wrong person, then it may mean that there will be a lot of discrimination in terms of on that basis, Chair, we request that that penalty is revised downwards. Allow my colleague to just take us through the 3 remaining issues on tax administration. Then we can move to the last set of submissions. Thank you, Chair.
Thank you, Fred. Chair, I draw attention to the waiver of penalties and interest. So through the Finance Act 2023, an amnesty program was introduced, which lapses next month. So our proposal is that the amnesty program should be extended to next year. This will give enough time for the KRA to conclude its audits and also for taxpayers to source enough funds to settle their debts. Further, we also recommend the reintroduction of Section 89, 6 and 8, which was scrapped by the Finance Act 2023. This will introduce a general...
And members, it's important to know that this is a new proposal, not currently in the bill. Proceed.
Thank you, Chair. Yes, this is a new proposal for the reintroduction of Section 89, subsection 7 and 8. This will provide a general provision for the waiver of interest. This will allow the Commissioner to waive penalties and interest, especially where there is undue distress. Thank you, Chair.
Good afternoon, Chair, and honorable members of this committee.
Maybe this one, a quick one. KRA, so far we saw, I think, 620,000 taxpayers get out of blacklisting, if I call it like that, and collection of, I think, 290 billion. So what do you think about the proposal to extend the waiver of penalties and interest?
Thank you, Chair. I want to make a request on this, because the waiver program is still running. Assuming we put an amendment now, then those people who would have wanted to apply for the waiver will not come forth. So I think it's a matter that we can look at and see whether we can have it. Yes, yes.
The program is already ongoing.
Yes.
That's very good. Proceed.
Thank you for that, Chair. So for purposes of the record, my name is Kimutai Kandie. I'm supporting Deloitte on the final 2 proposals, being proposal number 28 and 29. So for 28, this speaks to a proposal that is not captured within the bill, particularly being in terms of the timelines within which taxpayers may object to an unfavorable assessment. So we have to amend Section 5111 of the Tax Procedures Act to increase the timelines within which the Commissioner should revert to an objection with an objection decision from the current 60 days to 90 days. That more or less becomes a 50% increase in the Commissioner's timelines under the law. Now, our proposal on this issue, and in the interest of equity, is to extend a similar increase to taxpayers in terms of their response to an unfavorable objection. So currently, Section 51(2) of the Tax Procedures Act requires taxpayers to issue an objection within 30 days of receipt of an assessment. Our proposal is for that period to be extended from 30 days to 45 days, being a similar 50% increase as has been accorded to the Commissioner. So that's about it from a Tax Procedures Act perspective. Now looking to the final proposal, and this relates to other measures captured under Part 7 of the bill. Here we are speaking to Clause 63, that through which the bill seeks to amend Section 51 of the Data Protection Act 2019 to exempt the Commissioner, or to exempt the processing of personal data from the provisions of the such processing of personal data is purposed at, or rather is being performed